All right. Well, good afternoon, everyone. This is Mark Clinton, a senior mentor with Sheridan Mentoring. I have been mentoring here for Dan Sheridan since 2007, and went through his program back in 2005. Really changed my trading life. I've been trading futures and options since about 2000, so I've been around the game a long time. I've taught a couple of these courses on here before. But this one's going to be a lot different than the other two. There'll be more vehicles, different vehicles, and some different strategies than we did before. In fact, I think we're probably only going to revisit maybe one of the strategies that I taught before. I think everything else will be probably new. Let's get started here. Why futures? You hear a lot of people talk about futures. There's a lot of people that day trade futures. This won't be day trading in general. I mean, there might be a trade to get off in a day, but that's not the object of the game to be in and out by the end of the day. But the futures are a very large and liquid market that trades nearly 24 hours a day, Sunday afternoon, 5 Central to 4 o'clock Friday. It's hard to beat that. There's, I think, 22 and a half hours a day for a lot of these futures. In the equity market, if you put on trade in SPX or maybe an Apple, if something happens overnight, you have that gap risk, we call it, where in the morning the market doesn't open until say 8:30 Central, but maybe the market's already moved a lot and you can't even protect yourself in your option position because the market wasn't open, and that can be a very difficult situation at times. Well, in futures, there's a lot less time for you to get a gap opening. Yes, you could get a gap opening between Friday afternoon and Sunday, but the other hour and a half a day from there on is not real likely. So that's why one of the reasons I like to use futures is that nearly 24-hour day trading cycle and very favorable margin. In futures, they have what they call SPAN margin, stands for Standard Portfolio Analysis of Risk, and that means you'll actually be taking all the risk on, but they won't be holding it all out of your account at once. For instance, maybe you have $5,000 in risk. They might, for instance, only hold $2,000 out of your account initially. And what they do is, though, you always should be prepared for your full risk because they will creep that margin up as your position if it does get worse. So don't get a false sense of security, but it is a very nice feature to the futures market. It's very favorable margin, broad range of vehicles, and liquid markets. Some of these markets are some of the most liquid markets in the world. So what I'm going to teach in this class, it'll be 4 classes lasting around an hour each. Those of you who've taken my classes before know I'm pretty much all business with my class. There won't be a lot of fluff. We'll get right in there. We'll cover the topic. We'll look at some trades, and that will be that. And of course, answer questions, but it'll be down to business, probably about an hour. So the first class, of course, I'll give a little overview of different futures, but I'll be talking about non-directional strategies, iron condors or butterflies on certain futures that I might like to trade those in. And we'll talk about, how futures might be different in those instances, or the underlying vehicles might be different than, say, SPX or Russell or whatever you're trading in the equity market. Class 2, I'm going to talk about pairs trading. Now that's trading. I'm going to show one of those today also. But pairs trading is where you sell one and buy another, sell one vehicle, buy another vehicle. And it's very close cousin to futures calendar, meaning I sell 1 month of, say, crude oil and buy the next month or whatever it is. I might buy July and sell December or that type of thing. So that's what we'll be covering. We'll be covering pairs trading, and we'll be covering futures calendars in that class. And futures calendars, or some people call them monthly spreads, are one of the, I guess you could say, less risky ways of trading the futures market. Rather than trading an outright future, which can be, quite expensive, you can trade these pairs for a lot less money. because you're really sort of hedging yourself by selling one, buying another. All right, so in class 3, I'm going to talk about money management. How can I trade this if I don't have a lot of money? What could I do if I have a larger account? What's the difference? How much money you might want to allocate to what particular vehicles or features or strategies. And also talk about, for smaller accounts, expressing your market opinion with options or futures, and even for larger accounts. Some trades, if your account's really small, you might want to just do options, or if your account's large, you might do futures, you might do options. It depends. So we'll talk about how you might deploy the capital that you do have. And then in class 4, we'll talk about some speculative strategies where I have an opinion. Right? I got an opinion on oil, I got an opinion on soybeans, or whatever that may be. We'll talk about that. Okay? Any questions on the class structure before I go on as far as what we'll be covering? And I'll try to catch your questions along the way here. I may catch a lot of them towards the end. So let's go on to the next slide. So what futures products am I going to talk about? I'm not saying it'll be all of these or limited. It'll be all of these, but it might not. It might be also something else. We'll see. We'll see how the flow of the market goes, because what I want to try to do is cover the topics I mentioned in each class, and then maybe look at a trade in each class. So we'll see what's presenting to us, see what we want to do. So we'll be talking about currency futures, not currency. Not the Forex market where you're out there trading, the individual currencies, but the futures on the currencies, the CME products. We'll be talking about those. In fact, I'll be talking about one of those today. We'll also be talking about energy, meaning oil, gas, maybe natural gas. We'll see what we want to find over in the energy market. It's really interesting. When I first started trading futures in oil, say 10 or 15 years ago, it was completely different. Really, for a retail trader back then, it was untradeable. Oil really was. There was extreme gap risk. There wasn't overnight trading. There was a lot of bid and ask issues. You'd say to your broker, okay, I'll pay the ask, and then they tell you it moved again. And just a lot of very cumbersome issues. And not only that, when I first started trading futures, I remember options contracts being $50 a piece. Wanted to sell a call on oil, $50, in brokerage fee. Now, it depends on who you're with. You might be paying $3, you might be paying less for an option contract. So it's much, in today's market, the retail trader can do things they were never able to do before with brokerage platforms and information that you have access to nearly 24 hours a day. So it's a much better market to be doing all these, and particularly oil just comes to mind, because I remember how hideous it was to try to trade oil. Didn't seem like there was a truth in bid and ask like there is now. We'll also be looking at gold and positions you might do in there, futures, options, whatever that may be. We'll be looking at treasury bonds and treasury notes, probably the 10s, the 30s, maybe even, the 10s, the 20s, maybe the 30s, maybe even some of the other notes. So we'll talk about that and how you can trade those individually and how you could trade them against each other. There's a lot of complexity to it, but there's some things you can do trading one duration against another, say buying or selling a 10-year note, and at the same time selling or buying the 20-year bond with EB. So there's a lot of different things we can do in treasury bonds. And then you also have agricultural products. I won't guarantee we'll cover those. If a trade opportunity comes along, I'd like to. I'm going to certainly do my best to find an opportunity in the ags. But you got to be a little careful this time of year, growing season here in the U.S. for a lot of these, a lot of reports. So you got to be a little careful, but I'm going to try to find something in the ag products. But the other ones, the currency, the energy, the gold, the treasury bonds, we should certainly be able to do something with. And we may even wander into ES a little bit, the S&P mini future, probably take a look at that too. So I'm going to pause here again for any questions that come up over what I'm covering or the content of the class itself. No questions? You guys have got it. All right. So what I want to do, though, when I do teach you in this class, we'll look at some live trades, and we'll look at one today. But I really want you to teach you to fish, all right, so that you can handle these things for yourself, and you don't need somebody like me around all the time. So whenever we put on a trade, we'll talk about, of course, why we did it and what we'll do to get in or out as far as what's our profit goal, what's our max loss. And then the next time we get together in one of these 4 classes, we can take a look and see what happened. I'll make notes on what I did, and we'll compare them, and everybody can ask questions that may have came up, and we'll just kind of review the trades we did do, whether they were good, bad, or indifferent, right? Some of these trades may not work. You just got to be comfortable with that. This isn't a win-always situation. Nothing is, right? So today, I wanted to leave you guys with an example of pairs trading. Now, in pairs trading, as I'm going to do it today, what I'm trying to do is pit the weak against the strong, or maybe the strong against the stronger, or whatever it may be. And for a lot of these like this, I like to just use a simple 15-minute chart, maybe back it up looking at the 1 hour or daily chart to say, hey, this entry point looks okay for a shorter term trade. Most of these will be shorter term. You know, a pairs trade, many of these I'm in and out the same day, but I might be in it a few days. You know, something like what I'm going to talk about here, where we're talking about that's the symbol for it there, the /6AM8 June 2018 Aussie dollar future. And then you have the 6N, which is the June 2018 New Zealand Kiwi future. And by the time we meet, we might be using the July contract too. So, but today we'll be using the June. And futures some futures have more months than others. Some futures, there's only 4 future months a year, like bonds, for instance. Some have them every month, like ES, for instance. But what I've looked at here, and I'm going to show you here on the chart, is it looks like the Aussie dollar. Maybe it's trading a little higher against the New Zealand Kiwi, which is what they call their dollar, than what it normally does. Now, it may continue that way, but I'm going to play it to maybe take a pause from trading so highly above it. And I'm going to show you this trade, and it's going to be real simple. You close the trade if you get $100 in profit. You exit the trade if you get $100 in loss. That's my philosophy for this trade. If you don't, you know, I encourage you to do this on paper, by the way, not live. But I'm going to tell you, I'm going to do it live, and that's what my parameters are going to be. Close it at 100, either direction, and I highly encourage you today in all classes, you should be doing paper trades. I'm not in your wallet. I'm not in your portfolio. I have no idea what's best for you. You know, sometimes people go, oh, Mark, should I do this trade today? How do I know? I don't know what your long-term goals are. I don't know what your account size is. Any of those things. And many of them do have weekly options, and we'll look at some of those, TJ. So keep that in mind. I'm not recommending you do any trade live. My goodness. How do I know what your situation is? I'm just going to show you ideas, concepts. This is for education only that I'm doing this today, and for all of these courses that I'm going, all 4 of the classes that I'll teach for this course. So, that being said, let me show you what I'm talking about here with the Kiwi versus the Aussie dollar. Okay, so what I've done here, and I use TD Ameritrade. I'll be putting the trade on live in my live account, which is on another computer next to me. This is a simulated trading screen, but it's live data, no different, except it's not live money, but it will be when I put it on over in my other account. So this is in Thinkorswim. You can go to Trade tab and then Pairs Trader. You don't have to have Thinkorswim. You don't have to have, or TD Ameritrade. You don't have to have a Pairs Trader to do this, because I don't even have to use this. I could simply go out and I could build this chart myself quite simply by going to charts, which you can do in Thinkorswim, and I think probably just about any brokerage platform. And what you would do is just do 6A, and then you do minus / 6N in this instance. And that's a daily chart, right? But it's the same chart. So you don't need TD Ameritrade or Thinkorswim for this course to be worth it to you. I like TOS. I've been using it for 13 years. I think it's a very good platform. Okay, so that's what it looks like there. And I'll go back over here to where I was. And it looks, of course, the same here. So one of the things I like to do, sometimes I'll go out and look at fundamentals. You know, maybe that not only is the chart favorable, but maybe also there's some other feature that makes, say, the Aussie dollar weaker in this instance, or the New Zealand Kiwi stronger, maybe both, fundamentally. But this one, I'm just using this as an example. This is a paper trade. I'll go ahead and execute it live just so I can talk about it the next time around. This is simply a chart play, 100%. That's all it is. So we're at this upper part of this range. The New Zealand Kiwi, I think, looks a little better here than the dollar, which is what you're seeing. This is telling you, for instance, if I sold the Aussie dollar here and bought the Kiwi, if this goes down, if this price graph goes down, I make money. If it goes up, I lose money. Right? So if it ran up to here, I might very well be out of the trade. If it continues down to maybe the bottom of the channel, I'll probably also be out of the trade, but profitably. So a lot of times I'll look at these, and I'll talk about a lot more nuances in the course. But I'll look at these, and then this is a 15-minute. That's my starting point. And maybe I'll go look at the daily or the hourly. Let's go to the hourly. Am I seeing anything on the hourly that says, oh, wait a minute, that 15 doesn't mean a thing? Well, I'm not, right? I mean, it doesn't look tremendously strong on the hourly either. And then I might even go out for further confirmation to the daily, which, you know, doesn't look as bad as the hourly or the 15, but it also isn't showing me anything that frightens me off a short-term trade like this. Okay? So we'll go back to the 15. Now, you can simply go out and sell the Aussie dollar, buy the New Zealand Kiwi individually. You could do that in TOS or whatever you're using. Or if you have TOS, you could do this sell pair feature. Now, when you hit sell pair here, it's going to sell whatever's first and buy whatever's second. And by the way, this allows you to do it in ratios. We'll talk about that. Some things you're going to want to maybe, because of their notional value, you're going to want to maybe buy or sell less of one than the other. Say, for instance, a 10-year note versus the ZB, the 20-year. If you're going to trade that, it's 3 notes to every 1 contract to ZB. So if I wanted to, say, sell notes against the ZB, I'd be selling 3 10-year futures and buying 1 20-year future. And we'll talk about that and notional value and that type of thing. But these are very similar in notional value, so you can trade them 1-to-1. And with this feature also, you could even tell it, hey, I'll execute it if it gets up here. But for, you know, sake of our class, I'll go ahead and put this trade in here. So I'm going to go over here to my live platform, and I'll put this trade on. And I'm going to do it myself in the Pairs Trader. Make sure I get everything lined up right. Yep, okay. And then we'll head on over here. And what it does in the Pairs Trader when you send that is it goes ahead and executes it, which it just did live on my other screen. So let me go ahead and sell it on this screen so it looks very similar. All right, so now we have this trade on. And this is my simulated things. You'll see some other things. But so what we're simply doing is now when you go to however you monitor your account, this is Thinkorswim, we're looking at the P&L open, okay? And whenever I'm up $100 between the two of them, I'm going to close this trade. So it might be that I'm up $200 in the Aussie and down $100 in the Kiwi. What's that? That's $100, right? So, I mean, it could be a lot of things. You might be up 400 in the New Zealand Kiwi and down 300 in the Aussie. That's $100 profit. You take it off. Same in reverse. We might be down $100 in the Aussie. Maybe the Aussie's trading at 200, New Zealand Kiwi's only trading at 100 profit or a $100 loss or whatever it may be. So any combination of profit and loss between these two that equals $100 to the good, you'll close it. Or if it equals $100 of a loss, you'll close it. Okay? So right now, for instance, it's 10 and 20. I'm up $10, right? I'm up 20 on the Aussie, down 10 on the Kiwi. So that's how this trade would work in a pairs trade. And you can do this in all different things. There's even stocks that you can compare one to another. And like I said, inter-month spreads and all that type of thing in different treasury bond durations or whatever you wanted to do, or oil. But I have this trade on live, and I'm going to keep notes so that whenever we do have our first class, which I'm going to let Johnny come on and tell me when that is. Again, I believe it's the second full week in June, not the week of June 3rd, but the following week. I believe it's Monday and Wednesday for 2 successive weeks. I'm sure the information will be there on the site. You see, here's interesting. I'm up in both of them, so that's the $20, right? If you looked at that, I'm up $20 because I'm up 10 in each. So the configuration can be however it is. Do you pair this trade randomly? I mean, anytime. I trade any trade that I'm going to do. I do it because either I like the chart and or the fundamental story of one future against another. Right? It could be, as far as day of the week, I wouldn't trade this on a Friday. Normally, I don't do much trading new trades on Fridays because of the weekend coming up. But Monday through Thursday, yes, if I wanted to put this on for whatever reason, I'd go ahead and put it on. See, we're up $30 right now, 20. So it could, like I said, you could be out of this quickly in either direction. Don't get me wrong. And when we get further into pairs trading, we'll talk more about determining a profit that you want to get and a max loss. I just made this very simple. Very simple. We'll talk about using options to express opinions like this. So there's a lot more we'll get into in the class that I'm not going to cover here, in a basic get acquainted webinar. But that's the kind of thing we'll be doing, pairs trading, as well as the butterflies, iron condors, and what I'll talk about which futures I like those in, and maybe other things where we buy a future and sell options against it, or sell a future and sell options or buy options, or however we want to do it. We'll talk about buying options. This won't all be, you don't always have to do theta positive trading. Now this one has no theta effects, right? But if you sold a future and bought a future, there's no time decay like there is in options. But we'll talk about how you can use options in the different things. See here, I'm up 40 on one, down 30 on the other, so I'm up $10. You mean one future contract is equivalent to one option on that future? No, I'm not saying that at all. You'll have to do that differently at times. You might need to buy 2 options for every one future you were going to buy. That type of thing, Leon. So, any questions on what I've shown you here today, or any more questions about the course? I'll be happy to answer those now. I think you're going to find this very exciting because there's so many different ways you can trade futures strategy-wise, and there's this the margin favorability is very good. And I encourage everybody, by the way, if you're taking the course, to go to cmegroup.com also and read about the different futures, their contract specs. We'll be touching on that. When we trade different futures in the class, we'll look at their contract specs and we'll talk about it. As well as we'll be talking about some other, there's some neat features on the CME Group site where they're trying to help out the retail trader. So we'll look at those. We'll talk about how to take advantage of those and how you might use those. Okay. You know, I'm looking at this paper trader and it's just bouncing pretty much perfectly with my live. Interesting. Very little difference, slightly, but not much. Am I fully protected if I sell one E-mini SP500 and buy one option at the money? If you sell an E-mini future at the money and you bought say you sold the E-mini at 2,700, and then you bought the 2,700 put. Well, you're covered to the extent that no matter how far down it goes, you'd be protected past what you paid for that put. However, if it goes the other direction, you're getting burned twice on your long put and on your short future. So anyway, and we'll talk about that kind of thing whenever we get together and do this class. Any other questions today, particularly about the course? I just want to give you a little taste of what it'll be like. And like I said, a lot more strategies to come, a lot more futures vehicles to come.
I just put the live link in there for you as well, Mark. So anybody who's interested in learning more about the class, I don't have a banner on the homepage yet, but that link is live and it's under the online classes. So you can go sign up now.
And thank you, Johnny. And Peter, high's a relative word, okay? I don't know what you're paying, but let's suppose you're paying $3 a contract. And I just did this trade. So that's $6 in to sell one, buy one, $6 out. So that's $12. So if I truly got out at 100 profit, I'd make $88, right? Or if you want to account for that, you could say I'm going to get out a little higher. I mean, is it higher than equity options? In my experience, it is, but it depends on who you're trading with. But I don't consider $12 on a trade that maybe I'm going to sit in sometimes and make thousands. I don't really care. Or hundreds. I'm not going to lose sleep if I make 300 or 400 on a trade and I spent $20 to do it. So, yeah, they're a little higher, but I don't think they're in any way prohibitive on their price. If your expected profit on a potential trade overcomes the commission fee, is any particular commission high? That's a good point. The higher commission is more than offset by the low margins. Thank you, Ned. That is exactly right. All right. Well, that's what I have for today. So I want to encourage all of you to take this course. I think you're going to get a lot out of it. I think you're going to be able to learn a lot. And I highly encourage you to take it. It won't be starting here for a few weeks. So you got a few weeks, to prepare, maybe read a little more about it. And I look forward to being able to teach you guys and go over trading with you. And I hope to talk with you guys in early June when this starts. You'll be getting emails again, I'm sure about it. And there was a link to it also in the chat feature today. So have a good one, everybody. Talk with you later on. Thanks for your attention.